Hello, DR. Good to see you.
Richard, it's great to see you again, especially on yet another eventful week where so many things have happened since we got together last.
Looks like the markets are breaking out, don't you think?
They have indeed. And not only have they broken out, they've broken out in a way that people can shout from the highest mountain about it.
Right. Well, let's take a look at some of the charts.
Yeah. Let's look at that mountain from whence they're yelling, because they are yelling to the point, Richard, that I've even heard some of the folks that I know are complete permanent bears. The perma bears have been saying, well, maybe I've got to get bullish, and it's all because of this one stinking chart. So if we look at this chart, it's showing the S&P 500 from the end of from actually it was the middle of October of last year. If we look at the low point back then to where we closed on Friday, it's gone up 20% close to close. And people go, oops, that's automatically, technically a bull market in the S&P 500. And I'm guessing that you're right in line with them. That just means everything. Or you might say it doesn't mean a darn thing.
I have to say, this makes me embarrassed to be an American. I mean, to say that an arbitrary number of 20% is the definition of a bull market is so ridiculous, DR. I mean, can we just do some simple math here? Okay, let's say you're at $100 and you fall 20%, which is the so-called definition of a bear market. Now you're at $80. Can we agree on that?
Indeed.
I know we can't agree on much these days, but I hope we can still agree on math. So you're at $80. Now you go up 20%. Okay. Again, let's do the math. 10% of $80 is $8. 20% is $16. If you add $16 to $80, you're at $96. You haven't even made new highs yet. So what the heck? I mean, that it's down 20% is a bear market and then up 20% is a bull market. This is such numerical illiteracy. I can't believe it. Besides the just ridiculousness of letting the media somehow define something that, oh my gosh, it's a bull market and I'm going to miss out if I don't just get on board here because it's up more than 20%. So please, let's just move on from here. Do not pay attention to this whatsoever. It's absolutely meaningless. It reminds me of when my mom told me, forgive me if you're listening, Mom, that Dogecoin was cheap because it was only 75 cents a coin.
And what
I better, zip it up and throw away the key or I'm going to lose it here. So I can't look at this anymore. Move on.
We got to move on because it's just the gamification of the markets and trying to get people to react and respond and do something that they wouldn't have done had they not listened to, a new thing, a fear of missing out.
Well, here at least is a little more substantive number, okay, other than the arbitrarily defined definition of a bull market. We actually have CPI here, and we got the new number since we last spoke. And total CPI is down sharply, down a little bit more even than what the market was expecting, if I'm correct.
Yes, you are correct. It was lower. It was actually on a year-over-year basis. It was down to about 4% on the total CPI. If we look back, comparing it to this time last year, and people were looking for it to be about 0.9% higher. So that's a pretty good drop, and it got people really excited when the number came out Tuesday of this week, and the market's got a really good pop on that number. And there's probably a good reason for that. Inflation slowing down allowed the Fed to do what they then did on Wednesday, Richard, which was to stop raising rates, at least for a little while.
The hawkish pause.
Uh, yes, I got asked that very exact same thing this morning about the hawkish pause and did I think it was going to last? And again, does it really even matter? Does it really even matter if it lasts or not? I guess if they just never raised rates again for the next 2 years, we'd have something to talk about, but
So
we know they'll need to.
look, it's looking Goldilocks to me, DR. We got a bull market. It's higher than 20%. That CPI looks like it's collapsing as fast as it rose. So should be down back to 2%. I don't know, by July, August.
uh, yeah, maybe not by
Let's take a
July,
look
August.
at one of my charts. Okay, so this is the consumer price index. Here we are. This is the data isn't quite as current as what you were showing there, but this chart goes back to 1967, the year I was born. So, and we saw the CPI rise above 7% back then, and then fall equally as precipitously, and even get down below 3%, which looks very similar to the trajectory that you just showed on the current chart, right? But then,
Sure.
oops, back up to 12% before, now Fed's got it under control. Whew, thank goodness, we can all breathe a sigh of relief. Now we're down to 6%. Oops, all the way up to 16% before finally ultimately collapsing. So the 1970s to me are the decade to be paying attention to right now. I don't believe that the Fed has things under control. They even raised their own projections for, the terminal rate to, a full half a percentage point to 5.6%. So this narrative that, oh my gosh, consumer prices collapsing, CPI is collapsing, bull market is raging, we're above 20%. This is ridiculous. And speaking of ridiculous, let's talk about NVIDIA for a second. NVIDIA is at 221 times earnings. Okay. What does that mean? Here's earnings per share right now. This is just off Yahoo Finance. You're earning, $1.94 per share in earnings as a shareholder. Okay. You're paying $426 for NVIDIA at this moment in time. It's going to take you 221 years of earning $1.94 in order to make back your purchase price of $426. 221 years. This isn't Amazon in 1995, folks. This is NVIDIA, which is already a $1 trillion company.
And already bringing in
like
billions
$5
of
billion a
yes.
year, right?
In earnings. Not
in
just
earnings. So their earnings, I can't even, it's inconceivable. Like you're buying NVIDIA right now. You think NVIDIA is going to overtake Apple. Here's Apple's numbers. Okay. They're earning $6 per share. It's going to take you 31 years, but not 221 years. That's pretty pricey PE right there also. So the idea, you're basically betting that NVIDIA is going to take over Apple as the most valuable company in the world. So I know some analysts came out this week saying that, we're at 1995. AI is at kind of comparable to where the internet was in 1995, meaning that, there's 5 years of a raging bull market in AI ahead of us. I just don't think that's the case. I think that's absolutely ridiculous. So look, I get it. It's tough right now. If you have been sitting on the sidelines of this market, and look, I've said that I have had a significant amount of money in cash. I haven't been all in on this market. What do? Do you go chase this market right now? Well, I'll tell you one thing you don't do is you absolutely don't just kind of get into this binary, state of mind of like, I have to do this or I have to do that. I have to buy NVIDIA or I don't, or, I have to do nothing, or I have to, go all in this bull market or do nothing.
right?
Yeah.
There are alternatives. And I
There
think that
are alternatives.
one of the things that we're looking at even if the tech world explodes like we're thinking, it's going much quicker than even the internet boom did before, Richard. So I think that you're going to have to be as an individual investor, you're going to have to be a bit more patient and understanding what's going on. You're not going to be bouncing in and out. And I bet you've got some ideas eventually for what we can think about in
Well,
terms of doing something. So what? So what next if I have
I
some
just
money to
like to
put to work?
show, a simple idea
Yeah.
from my Finiac product, which is still free right now. You can sign up for free. So here I created a portfolio with just one stock in it, NVIDIA. I don't want to go into all the numbers here. If you haven't seen this before, you can learn more about it at finiac.com. But this is just a portfolio with just NVIDIA in it. So meanwhile, I can go over here to collections now, and I can look at an investor that I like, Rajiv Jain of GQG Partners. He's an activist manager, right? So he's picking stocks focused on value and other things, but a pretty reasonable guy with a good track record. So here I can look at the 100 or so stocks that Rajiv has in his portfolio, and I can look at how they're correlated to NVIDIA. I can rank them by correlation, and I can go down in here and start looking for what stocks are uncorrelated to NVIDIA. Northrop Grumman, Petrobras, United Health, so defense, energy, health, Schlumberger is in there, Novo Nordisk, Lilly, Humana, Lockheed Martin. So it seems like defense, health, and energy are all relatively uncorrelated to NVIDIA. Also, we can see here at a glance which stocks are kind of normally distributed, right? They're a little more normal in their price behavior, and which ones are a little more wild, like Petrobras or Schlumberger. So just to keep it simple, let's take United Health Group here, okay? And we'll add it to our single stock portfolio with NVIDIA.
And it'd
And
be
we'll
a
go
nice
back
add on
over
the
and
big
take on
pullback
it.
here. Yeah.
So look, right away we see that the histogram of the portfolio as a whole, okay, really lost its fat tails, right? Here's what NVIDIA looks like by itself. Here's what it looks like when you add NVIDIA and United Health together. 1 + 1 = 3 here. Yeah. And you got your diversification score up considerably. So we can go back to the collections again. And we can look for another stock now that's minimally correlated to those two put together. How about, let's see, what else? Lockheed Martin.
How about a great defense stock, indeed?
Okay. Now we've got 3 stocks in the portfolio, and we've tightened up our returns even more. Okay. So this is thinking outside the box, right? This isn't just letting the media define for you what success and failure is, right? It's not just it's a bull market or it's not a bull market, It's inflation crashing, and the Fed getting under control or not. It's not NVIDIA or nothing. So this is a strategy for getting your head, out of what the media is talking about, getting yourself in in the market, right? If you've been sitting on the sidelines, but also in a way that you can be more comfortable that you're not going to, get crushed. What if the AI narrative suddenly collapses, right? What if, something comes out, the regulators just say, nope, we're putting the kibosh on this thing. AI isn't happening. It's too dangerous. Or, whoa, look what AI just did. Is that crazy? Who wants to be a part of that, right? Which has happened before, right? So, if NVIDIA and the like suddenly get the rug pulled out from them. Even if it falls in half, it's still a crazy buy at over 100 times earnings.
Yeah.
Okay. So you can't just be in NVIDIA, but maybe you think, it should be in your portfolio, and that's fine because maybe it is 1995 in AI, but you've got to be diversified. You've got to build a portfolio of, things that aren't going to go up and down at the same time, but that are going to go up and down at different times. And that's what this product lets you do. So just to wrap up here, DR, I don't want to keep everybody too long, but just wanted to show briefly where I think we are in the cycles. This is the famous 40-month cycle in the S&P 500, in the stock market in general. We're definitely past the bottom of the cycle and in the rising phase of the cycle here. And, I had hoped to see more of a correction before things took off. I still think that could happen, but I do have to acknowledge that we are past the bottom of the cycle. The likelihood of there being a significant correction before the end of the year, I think, has gone down over the past week. But just on the daily cycles, this is zeroing in a little bit more. 168 trading days, about 2/3 of a year. You got the top here, you got the bottom here. And, we topped in late April, early May, and we have not had a correction since. In fact, it's been off to the races. So I still am expecting some headwinds from the daily cycles down into, July, August, but I have to admit that it hasn't happened yet. And I think the likelihood has decreased that we're going to see a significant correction before the end of the year. So meanwhile, I know that I've said all year, it's a tough place for investors. It's a tough market. One last chart to share with everybody. Income inequality is at its highest point in nearly 75 years. Okay. This is the Gini coefficient. I'm not going to go into what that is right now. You can look it up. It's pretty interesting, actually. But, the haves are having and the have-nots are falling further behind. And that's exactly what AI is going to exacerbate even further, right? This is not going to bring us together. This is going to divide us even further. It's going to be more power consolidated in fewer hands. It's going to gamify the whole economy even more than it already is. So don't just buy the narratives that we're in a bull market, that inflation's coming down, and that AI is going to the moon and it's a good thing for humanity. No. I say, overall things are going up and to the right like they have for the past couple hundred years. Exactly when that's going to happen, I'm still skeptical that we're going to see off to the races, for the next 18 months. I still expect a significant correction. I've still got some powder dry. Turn off the TV, diversify, and, watch out for the widening divide.
Indeed. And I think the tools that you pointed out there, Richard, are some of the things that people can look at, because even if the rug doesn't get completely pulled out of AI, even if it's just a pause, we've got to have a way to protect ourselves even from those modest, inconvenient pullbacks.
Yeah. I mean, I've talked about the minimax regret strategy, right? You're minimizing your maximum regret, right? So, I've still got a downside target in play on the S&P 500 of 3,200. Okay. That's not out of the question to me. That's back to, 2022 lows. I still think that's in play. I can't rule it out. I can't be all in on this market when I think there could be a downside of 3,200. I can't live with that, right? That's just where I'm at, an investor. Other people might be at a different place, right? I mean, if you're 20 years old and not 56 years old, right, you may be in a totally different position. But that's my maximum regret, 3,200 on the S&P 500. And I'm just not comfortable being all in when I think that's a significant, possibility that I can't rule out.
Well, and that's a powerful place to be too, Richard, that you know your values and what
Yes,
you want to have happen in your life, and what happens in the
yeah,
markets will impact you in a certain way that will impact me differently, that'll impact other people differently. And
exactly.
if you invest according to your values and beliefs, then you can sleep well at night as you do.
This may be a bull market for CNBC and Fox business, but it ain't a bull market for me. Plain and simple, and I'm not going to take anybody else's definition when I've got my own definition. And I think that's where more investors got to get to. And I hope we're helping them do that at least just a little bit.
Same here. I think some of the tools you showed today certainly will go a long way toward that, Richard.
Awesome. All right. Good to talk to you, DR. We'll do it
You
again next
too.
week.
You bet.
Bye.